Welcome to CoreLogic's Housing Market Update for March 2017. The February results from the CoreLogic Hedonic Index showed capital city dwelling values rose by 1.4% over the month, once again being fueled by Sydney and Melbourne, as well as strong capital gains across Canberra and Hobart, where the performance of the housing market has been gathering some pace. Weaker market conditions have persisted in the mining states, with dwelling values slipping lower over the month and over the year in Perth and Darwin, while Brisbane also slipped over the month. Focusing on the broader combined capital cities data, housing market growth conditions have been rebounding since the middle of last year, when on two separate occasions, interest rates were cut and investor demand once again started to trend higher. Prior to this, the growth trend across the housing market had been slowing, reaching a cyclical low point over the 12 months ending July 2016, when the annual change in capital city dwelling values slowed to 6.1%. Since that time, the annual growth rate has almost doubled to reach 11.7% over the 12 months ending February this year. This is the fastest annual growth rate since June 2010. Sydney's been the main driver of accelerating growth conditions across the CoreLogic Combined Capitals Index. The past 12 months has seen the annual growth rate in Sydney reach 18.4%. That's the fastest rate of annual growth since December 2002. The strong growth conditions across key markets have provided a substantial wealth boost for homeowners. However, the flip side is that home ownership is becoming increasingly out of reach. This is especially true for price-sensitive segments of the marketplace, such as first-time buyers or low-income families. Affordability challenges are most pronounced across the Sydney housing market, where, based on September 2016 data, dwelling prices are almost 8.5 times higher than gross household incomes. The second most expensive city is Melbourne, which has a dwelling price to income ratio of 7.1. So what's driving such strong growth conditions in some markets, while other markets are only seeing modest growth or declines? Well, it comes back to several factors. The first is economic conditions. Thanks to their strong services-based economies, Sydney and Melbourne have accounted for the vast majority of full-time jobs growth. Conversely, markets like Perth and Darwin, and to a lesser extent Brisbane, have seen weak economic conditions and flat to negative full-time jobs growth over a sustained period. Another factor is migration rates. Since the end of the mining boom, the mining states have seen a sharp fall in migration rates that's detracting from housing demand. The non-mining states, particularly Victoria and New South Wales, have continued to see a strong migration trend from both overseas and interstate, which is adding to demand for housing in the capital cities of these states. It's clear that the housing markets are continuing to move through an accelerated phase of growth, which is centred in Sydney and to a lesser extent in Melbourne, in Canberra and in Hobart. The rebound of the rate of capital gains is being led by investment demand, which is being fueled by low interest rates. Despite credit growth for investment purposes flattening in December, we've continued to see other market indicators corroborating the strong capital gain results from CoreLogic over the first 2 months of the year. Auction results have continued on from the strong trend of late 2016, with clearance rates holding consistently around the high 70% to mid 80% range from week to week. The last week of February saw a record number of auctions held for that month, with clearance rates edging higher despite the large number of auctions, which had the potential to spread buyer numbers even more thinly. Additionally, advertised listing numbers remain low across the hottest markets, with total advertised listings across Sydney tracking 11% lower from their already low base compared with the same time a year ago. The last week of February saw Melbourne advertised stock levels 5% lower than a year ago, while Hobart listings are down from a high base, falling by 35%, and Canberra listing numbers were 6% lower than a year ago. Low stock levels in these markets are underpinning a sense of buyer urgency, which is contributing to the upwards pressure on prices. The low number of homes being advertised for sale helps to explain why auction clearance rates are so high and why private treaty selling times are generally close to historic lows in the strongest markets. Overall, the latest results from the CoreLogic Hedonic Index highlights the performance diversity across Australia's housing markets. The continuation of the capital gains rebound is likely to create some further discomfort amongst policymakers, particularly in light of the growing debate around affordability and the high level of demand from investors. I remain of the view that housing market conditions will moderate during 2017 due to affordability constraints impacting on housing demand, as well as higher supply levels and an eventual slowing down of investment demand brought about either by changes to policies from Australian lenders or regulatory changes aimed at slowing credit growth across the investment sector. As always, a wide array of housing market data and commentary can be found at our website at www.corelogic.com.au.